Welcome to the Company Value Investor. In today's video, we are going to analyze a company, and the way we are going to do it is by focusing on the company's stock and the company itself through their financial statements. Let's find a good company here. Let's see. How about Netflix? Okay, Netflix. Currently the price for Netflix is $195. Average investor could consider or think of this as your FICO score. In 2016, the internal rate needed by Netflix to meet the expectations of their owners and creditors is 11%. Average investor, think of this as the credit card interest that you pay on a monthly or quarterly basis. Amount expected. This is the capital that the company needs in order to meet its obligations. Average investor, think of this as the amount of money that you need to make all your payments. And number 3 is the amount made. This is the company's real earnings, not the net profits, but its real earnings. Average investor, think of this as the amount that you actually made at the end of the year or at the end of the month. And the last item or section is the amount needed. This is the amount that the company, in this case Netflix, needs in order to maintain its operations. Anything positive here means that the company had an excess amount, which is very good. For the average investor, think of this as the amount you need to maintain your lifestyle. Anything positive is good. Anything negative is a deficiency, is bad. Okay, so the first thing I see for 2016 is that Netflix is an average stock. The stock is overvalued. However, it is a profitable company. Okay, first thing, average stock. What makes it an average stock? Well, the earning per share is less than 1. Its price to book ratio is very high at 31, and it retained earnings is about almost 100%. So that the fact that the price to book ratio is so high and the earnings per share is so low makes it an average stock. Now, why is the stock overvalued? Well, the stock currently is at $195. The reality is the stock should be anywhere between $150 to $155. And the reason why I say that is because although the company is profitable in 2016, they had negative cash flows. In 2015, they had positive cash flows. In 2014, positive cash flows. And 2013, positive cash flows. The reason why it's a profitable company is because they had real earnings. However, their negative amount expected was higher than the real earnings. But the thing with them is that they had excess capital, so they were able to offset any of the deficiencies here or here. Let's analyze 2015. Again, average stock, overvalued stock, and again it's profitable. The reason why it's profitable, again, because they had excess amount here. Technically, what you really want to see is real earnings here and a positive number up here. 2014, they had a decent year, average stock, overvalued, and profitable. 2013, and 2013 it is a weak stock, overvalued stock, and profitable. The reason why we keep seeing it as a profitable corporation is because they did have 3 out of the last 4 years they had positive cash flows. The problem that I have with Netflix as a company is that in 2016 and 2015 they had negative cash flows when it came to operations. They make their money on financing, believe it or not. So the question is, would I invest in this company? No. But let's take it through another test. Let's do the $10,000 rule of thumb. So if I was to invest $10,000 today, at the end of 1 year I would have a loss. And the reason being because the stock is overvalued. I would have a loss of almost $200. Even though they've had good cash flows, those cash flows were in 2013, 2014, and 2015. But let's take it a step further. Let's break it down to $5,000. If I was to invest $5,000, I would still have a loss. If I was to invest $1,000, I would still have a loss. And the reason being is because it comes down to the internal rate. They're expected to earn almost 16% on their investments. And the reality is, in the last few years, they haven't been able to even get close to earning this amount, this percentage. Okay, at best, they've made 2% at best. The reason why the stock is overvalued is because people have bought it, and they bought it because it's a hot stock. It's made very good cash flows, so that in turn makes it a profitable company. But at the end, the question is, would I invest in the Netflix company? And the answer is no. And the reason being is because the stock is overvalued. At best is average. They've made some cash flows. However, if I was to invest $10,000, $5,000, or $1,000 a year from now, I would have a loss in all 3 cases. And the reason being is because Netflix cannot, or has not, in the last 3-4 years, has not even gotten close, or even half of the percentage, the interest rate that they're supposed to attain in order to meet the expectations of the owners and the creditors. So all in all, I would not invest in Netflix. I hope that this video has helped you. If you have any questions or concerns, please post them below on the comments, or email me, and I'll be more than happy to explain or go into detail about anything that I have talked about in this video. As always, keep investing.